चैप्टर 10। आज हम पीएमएस कवर कर रहे हैं और ये चैप्टर 10 है, परफॉर्मेंस मेजरमेंट एंड इवैल्यूएशन ऑफ पोर्टफोलियो मैनेजर्स। तो फर्स्ट है पैरामीटर्स ऑफ डिफाइन परफॉर्मेंस, रिस्क एंड रिटर्न। द मेन issue is performance measurement and evaluation is the human tendency to focus on the return the investment has earned over a period of time, with little regard to the risk involved in achieving that return. Proper performance measurement should involve recognition of both return and risk of investment. तो रेट ऑफ रिटर्न कैसे मेजर किया जाए? तो द मोस्ट वाइटल स्टैटिस्टिक इज मेजरिंग द परफॉर्मेंस ऑफ अ पोर्टफोलियो is the rate of return. Rate of return has many possible definition. However, there is one possible definition for each purpose. So one should make for to obtain clarity about the purpose of for which the performance is to be measured. Rate of return measure करने के लिए बहुत सारे हैं, बट आइए देखते हैं. Holding period return. The most straightforward rate of return is the holding period return, SPR जिसको कहते हैं, popularly known as total return on point to point return. It equals the income generated by an investment plus the change in value of investment during the period the investment is held over the beginning value of the investment expressed as percentage per annum. For example, if the market value of an investor portfolio in 1st April 2018 1 lakh and on 31st March 2019 the market value of the same portfolio stand 1,20,000, the investor would have achieved a holding period of return equal to 20%. In general we can use equation. ठीक है, तो इसका कैलकुलेशन कैसे करेंगे? तो जो मार्केट वैल्यू है 1,20,000 माइनस 1,00,000 डिवाइडेड बाई 1,00,000, तो 20% रिटर्न आ जाएगा. फर्दर एज्यूम that during the same period the investor has received 5,000 by the way of dividend, the interest income, then तो 5,000 प्लस तो 25,000 हो जाएगा. SPR होल्डिंग पीरियड रिटर्न, इनकम, एंडिंग वैल्यू एंड बिगनिंग वैल्यू. This measure assumes that all income distribution are made at the end of the year. In spite of this limitation, total return measure is widely used and generally accepted indicator of performance. This is considered as the starting point of performance measurement exercise. दूसरा होता है, एक तो होता है होल्डिंग पीरियड, वो इजी है. अब दूसरा है टाइम वेटेड रेट ऑफ रिटर्न. तो इसको कैसे कैलकुलेट करते हैं? तो टेबल वन में जैसे 2015 में होल्डिंग पीरियड ऑफ द फॉर द ईयर 5% था, 16 में 15.20%, 2017 में 8.210, 2018 में 30.75, 2019 में 17.65. इन्वेस्टमेंट कंट्रीब्यूशन इतना था. टोटल टेबल 3 कंप्यूटेशन ऑफ रिटर्न्स एंड पोर्टफोलियो वैल्यू एट द बिगनिंग एंड एंड ऑफ द पीरियड. 2015 to 2019 investment made at the beginning of the year, return generated during the period, return made during the period, portfolio value at the beginning of the period, portfolio value at the end of the period. What is the rate of return generated during the period of 5 years? तो पिछले 5 साल में कितना रिटर्न जनरेट किया है, तो ये देखते हैं. 5,000, 10,000, 1 plus R power n. IRR is also referred as money weighted rate of return, financial. The Global Investment Performance Standards gives glossary defines time weighted rate of return as a calculation that computes period by period return on an investment and removes the effects of external cash flow, which are generally client driven and best reflects to the portfolio manager's ability to manage assets according to a specified strategy or objectives. The Global Investment Performance Standard (GIPS) glossary defines time-weighted rate of return as a calculation that computes period-by-period return on an investment and removes the effects of external cash flows, which are generally client-driven and best reflects the portfolio manager's ability to manage assets according to a specified strategy or objective. TWRR is the compounded rate of growth over the stated period. In TWRR, portfolio will be valued every time there is an external cash flow. If there is no external cash flow, TWRR is equivalent of SPR, holding period return. When there is an external cash flow, TWRR requires computing as a set of return for each period. These sub period returns will be linked together to compute TWRR for the evaluation period. Contribution made investor calculating return. The TWRR is the same as geometric return. Note that unless the sub period constitute exactly 1 year, time weighted rate of return will not be expressed as an annual rate, and we have to annualize the return. SEBI Portfolio Manager Regulation 2020 prescribes discretionary portfolio managers to disclose performance using time weighted rate of return for the immediately preceding 3 years. For the illustration, calculation of time weighted rate of return being with an account is funded on 1st January 2019 by an amount 50 lakhs. On 1st March 2019, client contributed an additional 20 lakhs. The market value of the account on 20th Feb is 49 lakhs. On 1st October 2019, the client withdraw an amount of 10 lakhs from the account. The market value of the account on 31st September 2019 was 75 lakhs. The 1st Jan to 20th Feb 49 lakhs minus 50,000 divided by 50, 2.20% negative. 1st March to 30th September 75,000 minus 49,000, 75 lakhs minus 49 lakhs, minus 20 lakhs divided by 49 lakhs plus 20,000. 70 lakhs minus 75 lakhs divided by plus 10 lakhs divided by begin with market value at the beginning of the period, move forward through the time towards the end of the period, compute the market value of the portfolio immediately before the contribution to withdrawal from the portfolio. Ending market value minus beginning market value minus contribution plus withdrawal divided by beginning market value plus contribution minus withdrawal. Repeat step 3 and 4. Arithmetic mean return AMR versus geometric rate of return. Suppose there are two portfolio choices available to invest 1 lakh. First choice produce a holding period rate of return is minus 50% in the first year and 100% in the second year. Another choice produce holding period rate of return is 10% in first year and 10% in the second year. Which one would you suggest? In case of first scheme, at the end of second year, the investor will end up with 1 lakh. The value of the portfolio is the same as it was 2 years ago. though the average annual rate of return on portfolio is 25%. With the second choice, the value of portfolio at the end of the second year is 1,21,000 on average annual 10% gain in value. Clearly, investor is better off with the second scheme, although it produces average annual return lower than the first scheme. To understand how the outcome in two cases are so different, it is important to distinguish the two methods of calculating returns. The average annual return arithmetic return is the simple average of individual total yearly return. To understand how the outcomes in the total case are so different, it is important to distinguish the two methods of calculating returns. The average annual arithmetic returns is the simple average of individual total yearly returns. The yearly return is sum of the percentage gain or loss in value of portfolio due to change in assets prices. Second, any dividend or other cash distribution expressed as a percentage of invested assets. The arithmetic mean is the simple average of a series of returns calculated by summing all of the returns in the series of dividing by the number of values. For the first choice, AMR is equal to minus divided by 100 to the best estimate of the future years returns based on a random distribution of the prior years return is the arithmetic average. Statistically, it is our best guess for the holding period return in a given year. If we wish to estimate the expected return over a multi-year horizon conditioned on past experience, we may use the arithmetic average. The second method of calculating return is the average annual geometric or compound return. The average geometric return is far more important than the average arithmetic. Return, if one is analyzing the long run return on assets, the average annual geometric return is the rate at which the sum you invested at the beginning of the period will accumulate to a given sum at the end of the period by the process of compounding or continuously reinvesting your dividends and capital gains. A characteristic of the compound return is that it depends only on GMR is based on exponential function which represents periodic compounding. As can be seen in the formula, the process of calculating the GMR is the same as TWRR. We are required to calculate wealth relatives for each SPR. Then we have to link this sub period gross versus net return. The gross return is the total return generated on investment before the deduction of any fees, expenses or commission. Gross return is stated for a specified period of time. Net return is calculated after adjusting gross return for fees, expenses or commission. Net return is the return investor actually makes. Hence, focusing on gross return can be misleading, though it can be used to evaluate the performance of investment at a broader level. Let us look at the following example of portfolio to understand the difference between gross return and net return. Given below is the information about the size of the portfolio, investment period, fees, expenses, size of the sample 100 lakhs, investment period 1 year, profile made during the year, 20% of the capital contribution, hurdle rate 10% of amount invested, other expenses such as brokerage, DP charges, structure charged on gross value of portfolio, upfront fee, meal, setup fee, meal, fixed management fee charged on average of capital contribution and gross value of portfolio performance. Capital contribution made less upfront fees, assets AUM, profit loss 20 lakhs. Gross value 1.2 cr less expenses 0.5 per chart. Gross value of the portfolio less other expenses minus fixed management 1.5%, 1 cr plus 2 cr divided by 2. Less fixed management fee 1.5% of like 65,000 portfolio value after charging fixed management fee 1.17 cr. Required portfolio value hurdle rate 10% of amount invested. Required portfolio value at the rate hurdle rate 1.1 and 1.1 T hurdle rate less performance fee 1,10,000 आया. Portfolio value after charging performance exit load 2%. Gross return is the total rate of return earned. For the above example is calculated as follows. Gross return, gross value of the portfolio minus capital contribution divided by capital contribution. Gross return 1.2 cr minus 1 cr divided by 1 cr. Gross 20%. Now return is the return earned after adjusted for the fees and expenses. It is calculated as follows. Net return is equal to net value of the portfolio minus capital contribution divided by capital contribution. Pre-tax versus post-tax return. The pre-tax rate of return are return before taxes, and post-tax return are returns after taxes are paid on investment income, realized capital gains. Investors belong to different tax brackets. Hence, the performance of the investment is communicated as pre-tax rate of return. Investor or their financial advisors are expected to calculate the post-tax return by adjusting the pre-tax return to tax rates applicable to the investor. Post-tax return divided by 1 minus tax rate. Pre-tax return enables comparison across different investment and the strategies, since different investor may be subject to different levels of taxation. However, what really matters to the investor is post-tax return. Hence, they make investment decision on the basis of post-tax performance. An example of post-tax return calculation is given below. An individual achieved 5% pre-tax rate of return for stock XYZ and is subject to a capital gain of 15%. The post pre-tax return is pre-tax return into 1.1 minus tax rate. The post-tax 5% into 1 minus 5%, 15% is equal to 4. Compounded annual growth rate. Compounded annual growth rate is a measure of an investment annual growth rate over time. With compounding, it assumes that the any dividend income rate declared by the investment is reinvested in the same investment on the day's market price. Here is the compounded interest formula to determine the CAGR between the opening and closing balance, where A is the closing wealth, P is the opening wealth, and R is the time period of years. Suppose the investment has invested 1 lakh in an investment for 5 years, the year 15 to 29. For calculating the CAGR, we need to calculate the terminal wealth, that is the end of the period of value of the investment. Annualizing return. For facilitating comparison, rate of return is reported on annualized basis. The annualized return represents the compounded average annual return of the investment. The calculation is same as the calculation of CAGR or geometric mean return. Return are annualized by following the same chain. Cash drag adjusted return. Portfolio manager may not invest the entire capital contribution made by investor for variety of reasons. However, while computing return for the investment period, the capital contribution made by investor need to be taken into consideration. It has been observed that portfolio manager were not taking into account the cash component in computing returns. An investor has invested 100 lakhs in equity investment portfolio. The manager has invested 75 lakhs in equities, and 25 lakhs are lying in the liquid fund. For the period of the equity exposure has generated a return of 7.5 lakhs, while the liquid fund has given 4%. Return on investment ignoring the drag cash has exerted 7.5 divided by 75 lakhs, 10%. Return on investment 10% into 7.5 lakhs plus 4% in 25 lakhs, 35,000 or 8.5 lakhs. Alpha and beta return. Most investment portfolio returns tangle alpha and beta decision together. The returns from such portfolio can be decomposed into alpha and beta return by using assets pricing model, CAPM. The CAPM theory is that risk consists of a systematic component, that is non-diversifiable, and a unsystematic idiosyncratic or unique component, that is diversifiable. Risk that is unsystematic can be diversified away, hence an investor should not expect compensation for bearing this type of risk. As per the model, investment are to be priced for their market risk, that is non-diversifiable risk. Market risk is discussed in beta, risk-free return. Beta of the security portfolio, return on a market portfolio. Alpha is the return generated by the portfolio over the required rate of return as per CPM. A portfolio has generated return of 25%. The market benchmark return for the same period is 15%. The beta of the portfolio is 1.5. Treasury bond yield is 5%. The return of the portfolio has the component risk-free return 5%, beta return, alpha return, actual return minus required rate of return. Alpha return is 25%. Alpha return. Portfolio return risk measures. Risk is the key dimension of performance measurement and decisive factors in selecting a portfolio manager. Total risk and downside risk. Risk is, in a generic sense, is the possibility of loss, damage or harm. For investments, more specific definition of risk can be given. It can be defined as variability in the expected return, total risk, or it can be limited to loss or worse than expected outcomes only. Downside. Two possible measures of risk have received support in theory to capture total risk. the variance and the standard deviation of the estimated distribution of expected return, whereas downside risk includes concepts such as semi-variance, standard deviation, and target semi-variance. Standard deviation. A standard deviation as a measure of total risk. A standard deviation and variance are measures of dispersion